Today we're going to cover Learning Objective 4, and this is going to discuss how we use the accounting equation to analyze transactions. Going back to several points we made earlier in this chapter, we're going to be using the accounting equation for, again, temporarily, but for purposes of recording business transactions. Ultimately, we'll move to more sophisticated ways and more efficient ways to record our transactions. First question is, how do you analyze a business transaction? These are very special types of historical events that require recording on the books of a corporation. First of all, when we think about the transaction analysis, two issues become critical. The first issue is whether or not an event should be recognized. And the second is measurement. So in the first case, for recognition, we recognize it if the event involves an exchange of economic resources. Then, once we get past the recognition stage, then we measure. And how do we measure it? We measure it based on the monetary unit assumption, which we covered in a previous module, that tells us that economic events are only recorded if they are measurable in units or in monetary units. And here in the US, we think of that as the US dollar. So if we take a look at the example, is this a transaction? Well, the first case, it is. Buying a copy machine for $4,000 in cash, first of all, it's an exchange of resources. The machine is exchanged for cash. Second, are we able to measure it in terms of monetary units? And yes, its current market price is $4,000, and it's measurable in terms of the dollar. What does not meet a transaction that is recorded is meeting a customer. There's no exchange of economic resources, and therefore no need to measure. Another example of an event that would not meet the recognition threshold is an interview. A potential employee. So in order to record a transaction, it has to be capable of recognition, an exchange of economic resources, and it has to be measured. Next, we analyze the transaction in terms of its effect on the accounting equation. Remember that the accounting equation must balance. It is sometimes known as the balance sheet equation, and therefore we have to ensure the equality of the equation, that assets equal liabilities plus equity. There is an equal and opposite effect of transactions on each side of the equation, and this is commonly known as the double entry bookkeeping system or double entry accounting. Let's take an example of an asset increase. If an asset increases, there must be either a corresponding increase in another asset, an increase in a specific liability, or an increase in stockholders' equity. So let's take this right to the accounting or balance sheet equation, and let's see if we can come up with some examples. Here in A, one asset increases and the other one decreases. This could be, for instance, the acquisition of inventory for cash. Next, an asset increases again, but this time a liability is used to cover or on credit to acquire the asset. So let's say inventory increases again, but in this case, now you have an increase in accounts payable. Now remember, these are open or trade accounts, so just like you and I can do, we just go online, give our credit card number, no formal document to sign. You don't see any stipulation of a formal interest rate, which of course would be the case if this was a note payable. And finally, an asset could increase when there's an increase in equity. So let's say someone invests in this company. We have cash, and we have an increase investment by an owner, and maybe that increase is going to go to capital stock or common stock. Okay, so there is a balancing effect. Every transaction must affect one account equally and in the opposite direction. So it either is an increase in an asset, a decrease in another asset, in this case, increase in an asset, increase in liability, or the asset increase is due to an increase in stockholders' equity. Now, there are many other combinations that we'll see as we go through our next example. This illustration comes from the textbook, and Smart Touch is a company that we're going to be looking at throughout the semester. Again, it's part of our textbook sample company, and right now we're going to look at this company from its inception. And we're going to assume that the company starts off, of course, with no cash. So, you don't have anything when you start. So initially, there's no assets, no liabilities, and no stockholders' equity in this business. But now, the owner issues 30,000 shares of common stock and raises capital. And as a result, the asset cash increases and common stock increases or equity increases. There are no liabilities as of now. And this common stock is at par or face value. The next transaction, that cash is now being put to work. The company will now purchase land that is going to use in the business. Notice what happens when we go now to the accounting equation, and of course the equation is in balance initially. Assets are 30,000 and equity is 30. We now use cash to purchase land. So we increase land and we reduce cash. We now change the composition of the assets but not the total. And therefore, we go from a non-productive asset cash and we now hold a productive asset land. Notice that it changes the composition of the assets but not the total. Total assets are still 30. And of course, total liabilities and stockholders' equity are 30. And there are still no liabilities as of today. So again, the investment in land changes the composition of the assets, but not the total. Next, our sample company needs to buy office supplies in order to begin operations. In this case, the supplies are purchased, but they're not using cash. They use accounts payable, which is an open trade account. We go back to that. It's an open trade account, meaning we sometimes call this open or trade accounts payable. It means that it is due in 30 days and no interest is stipulated at that point. Obviously, if you don't pay it in time, interest accrues just like on your credit card. In this case, the asset office supplies increases and accounts payable also increases. No cash is used, but an asset supplies is on the books. And of course, at this point, total assets are 30,005. And again, you should always take a balance after each transaction. And total liabilities and stockholders' equity are also 30,005. Notice, of course, that the outsider's claim or the creditor's claim is now 500 and the owner's claim is 30. Total economic resources have to equal the claims against those resources. At this point, the company begins its operations, and in transactions 4, the company will provide services to customers, and they're going to pay cash. This is a cash transaction or a cash revenue. cash sales or cash revenue. We increase the asset cash, 55, and we increase stockholders' equity by increasing revenue. Remember the definition of a revenue. A revenue is an inflow of assets or a reduction of a liability. And you could reduce a liability when, as we said in the last module, when you have advanced collections. But in this case, there's no advanced collection. You're providing service for cash, and the asset inflow in this case is cash in exchange for goods or services. And in this case, it's services. So definitely defined clearly as a revenue is an inflow of an asset. In this case, it's cash for providing services. At the end of transaction number 4, there is a total of $36,000 of economic resources or assets, liabilities are 5, and stockholders' equity is 35.5. Taking the balance as you should after every transaction. Claims against those resources are also $36,000. The owner's claim is $35.5 and the creditor's claim is $5. Now, the next transaction, which is extremely important for us because we're providing services again, same revenue, but in this case, the customer will pay on account. So these are credit sales, not cash sales. But notice, revenue, equity goes up because of the revenue, increases by $3,000. So we still have an increase in revenue, and we have an increase in assets. Again, the definition of a revenue is an increase in assets. It's an asset inflow from providing goods or services. In this case, the asset that is increased or the asset inflow is a receivable. This is a promise to pay. It is an open or trade account. Open or trade account. It is not a formal document. Again, customer calls and places the order. You set up the accounts receivable and you record the revenue when the goods are shipped. So we have an increase in the asset accounts receivable and an increase in revenue. And of course, revenue increases equity. And at this point, your total equity is $38,005. And once again, you always take a balance of the equation. So the total assets here after transaction 5 are $39,000, and your total equity and liabilities and stockholders' equity also $39,000. So the balance sheet balances, and again, we have the equation in balance. Our next transaction is transaction 6. And in this case, the company has to pay some expenses. And it pays in total $3,200, in cash for office supplies $2,000, and $1,200 to pay employee salaries. Notice that expenses will reduce your equity. They are asset outflows or increases in liabilities. And in this case, the asset outflow is cash. So again, by definition, an expense is a reduction of equity or an asset outflow in this case from normal operations. And at this point, if we wanted to, we could calculate net income as revenues 85 and expenses 32. So the net income is $5,300. So at this point, net income is $5,300. And of course, after transaction 6, we still need to take a balance, as always, and we have to ensure that assets equal liabilities plus stockholders' equity. So after transaction 6, total assets are 35.8. Total stockholders' equity, your equity now, if you add this up, is the $30,000 of capital stock plus the $5,300 of income. So that's 35.3 plus the 500 in liabilities, 35.8. And again, the balance sheet balances. So once again, we are in balance. Balance sheet equation will balance. Next, transaction number 7. In transaction number 7, the company is now going to pay off some of its liabilities, and it pays it off by reducing the liability. I'll go back to that, I'm sorry. Reducing the liability, which is accounts payable, brings it down to a balance of 200 and reduces the asset cash. Now, again, you have to remember that accounts payable is a liability. Notice a couple of things that you can't start drawing conclusions or try to find a magic potion to memorize here, because cash goes down in this case, and the cash goes down not because of an expense or a dividend. It goes down because you're paying off a liability. And once again, in terms of the accounting equation, the total stockholders' equity is 35.3. Liabilities are 200, so that 35.5 is the total liabilities and stockholders' equity, and that is also true, hopefully, and it is, so we have the balance of the assets, 35,500 for total assets and 35,500 for liabilities and stockholders' equity. In transaction 8, the company will collect $2,000 from the client where they had performed services of $3,000. These were credit sales on account. So the accounts receivable was $3,000. Now we're going to collect $2,000. So we increase the asset cash and we reduce the asset accounts receivable. So once again, we change the composition of the assets, but not the total. Notice there is a cash inflow here, but there's no revenue. The revenue was already recognized, because if you look at our number, our cash sales were $5,500 and our credit sales were $3,000, and now we've collected $2,000 of that. So you don't recognize revenue now when you collect. You recognized revenue in the prior period when the services for the client were performed. And notice again that you did not change the total, just change the composition of the assets so that liabilities and equity would stay the same as well. So your total stockholders' equity in this case is going to be 35.3. Okay. And your liabilities, are 200. And stockholders' equity account is going to be 35,300, which is equal to 30,000 of capital stock plus the net income of 5,300. So the total liabilities and stockholders' equity, 35.5, and that equals to your total assets. Finally, we're going to summarize, but there is one more, an additional transaction. The company paid dividends to a stockholder of $5,000. Dividends, if we go down to the transaction, are a distribution of equity, distribution coming out of income. And therefore, we reduce equity and we reduce our asset cash. Notice that a couple of things. Number one, although we started with a balance of cash of 0, our increase in cash is 9,000. Increase in cash is 9,000. Notice also that when we look at the stockholders' equity section, dividends are not part of income because your net income again is going to be 53. So net income is 53. There's a couple of other things we want to notice here, and that is, and I'm going to do a little bit on the whiteboard in a second, but notice also that the cash paid for office supplies is 300, and yet the office supplies you hold are 5. So again, we don't necessarily work on a cash basis. We paid so far 3, but we also financed or we owe another 2. Cash expenses, of course, are 32. We know that's what was paid. And our cash revenues are going to be the amount of the cash sales of 5,500 plus the amount we collected on the credit sales. So our cash sales are 7,500, or our cash collected is 7,500. That would be your cash collected from customers. Now, I want to go to the whiteboard and explain that. When we look at our total sales or total revenue, we had cash sales and we had credit sales. So our total revenue is 8,500, and this is on the accrual basis. If we were interested in more of a cash basis or a cash flow, we'd look at cash collected from customers. And the cash collected from customers would include your cash sales plus the accounts receivable collected. And the total is your cash collected from customers. And that would be on a cash basis. Now, you have to think about the way we would operate as well as individuals. I mean, if we worked for a couple of weeks or a couple of months and we earned $8,500, but if we only collected $7,500, we would still say that our earnings are $85. And the difference between the two is the balance that someone owes us. It's the balance of accounts receivable, and that's $1,000. The balance of accounts receivable is going to be $1,000. And that's what you see back here if we go to our accounts receivable account. And there's one last point. Remember that dividends are not expenses. So again, even though they look like expenses, the only expenses we have are $3,200 in cash expenses. Again, we have the cash collected of $75. So the dividends are not expenses, just as the inflow of cash from the investment in common stock is not the same as a sales revenue. So going back to the whiteboard, again, we have to differentiate between the cash and the accrual basis. Other examples that I had is that you have supplies. $500, but you only paid $300. The balance is what you owe on a trade account of the accounts payable, and that's going to be the $200. And here, it's the balance of accounts receivable. So you notice that the primary difference between the cash basis and the accrual basis is that under the accrual basis, we take into account what is owed to us and what we owe to others. And as a result, we wind up with receivables and payables. Now, in our next module, we're going to be using, this is again going to be a temporary way of recording, where we're going to be using the accounting equation to prepare financial statements. So we'll see that in the next module in Chapter 1.